Let's now move on to the Q&A section where we take your top questions for today. Joining us in the Q&A section, we have Wei Ren, Dejun, Ferlin, and Ron. A big round of applause to welcome them up. Joining us in this session, firstly, is Wei Ren, Senior Portfolio Manager of Research and Portfolio Management at IFAS Singapore. Next up, we have Tan Dejun, Assistant Manager, Research and Portfolio Management at IFAS Singapore. And Ferlin Tan, Senior Research Analyst, Research and Portfolio Management at IFAS Singapore. Moderating this session will be Ron Ng from the Investment Advisory at FSM Singapore. Over to you, Ron.
Right, thank you. So on a day-to-day basis, right, the FSM Investment Advisory team, we actually get a lot of questions regarding markets and also individual ETFs or unit trust products. So other than today, we have gathered some of the most frequently asked questions, especially in current market conditions. And we are fortunate enough to relay it to our research analysts. So maybe the first one, that something close to Singapore will be the outlook for STI. I'm sure a lot of us will be interested in that. Dejun, would you like to address this question?
Okay. Good afternoon, everyone. Right. So the outlook for STI, I think first of all, let's take a look at the performance for the STI index over the year-to-date period. I think STI, like it was mentioned in the panel discussion in the morning, I think STI the Singapore equity market is actually one of the few markets that are that have positive performance year to date. I think that one of the reasons is really because of the composition of the STI and how that composition has actually allowed the STI to do well in the current environment where interest rates are rising. So inside the STI, obviously the major sectors are the banks, which make up around 40 to 50%, followed by your real estate, your REITs, which make up about 20%. So both of these sectors, they actually thrive in an environment where interest rates rise and there's higher than expected inflation. So for the banks, naturally, when interest rates rise, they can loan out money at higher rates compared to their cost of funding, which is the deposits that we as consumers put into the bank. And as for the REITs, they tend to enjoy positive rental reversions as rents and property prices rise, which gives them better performance. And I think given that if we expect interest rates to continue rising over the next few quarters, then I think the STI should continue to do well because it's mainly driven by these two sectors. And even though, the STI, because it has such a natural value tilt, and so despite mentioning the good things about the STI, I think it's also important to give you guys some talk a little bit about the negatives about investing in the STI. So things that you should be wary about is first of all, for the REITs, right? Although most of the REITs inside the STI index, they are considered your blue chip REITs, the bigger REITs. They tend to have lower cost of funding, and which allows them to sort of avoid this high interest rate environment for the time being. However, if your assumption is that interest rates are going to remain elevated in a couple of years, it's still going to remain high, then these REITs will inevitably be affected, and hence their rental income will also be affected. And on top of that, I think one of the dangers about investing in the STI over the long term using a buy and hold strategy is that because the STI's composition is mainly made up of blue chip companies, there is very little room for significant growth, unlike other markets like the S&P 500 in the US, for instance. So that is one thing that you need to take note of before you invest in the STI. So I'm not saying that the STI is bad and you shouldn't invest in it, but it's rather the timing and how you go about investing in it. So for the STI, I think it's better to go with a tactical approach. And I think now, with inflation still high and interest rates on the rise, I think the STI can actually be an attractive investment idea.
Right, thank you, Dejun. So, I think income is also a very important investment criteria when Singapore investors generally look to invest. And rising interest rates do like generally will provide better income solutions for investors. So like for the next few years, right? I believe this is the next question. What are some of the sectors or regions which will do well in the next few years because of the rising interest rate? So maybe Ferlin, you'd like to take this question?
Okay, yeah, sure. So I think one of the most obvious answer to this question is really the financials and especially the banks, because like what Tejin just said, the banks, they derive their income from net interest income, and which is dependent on net interest margin. So given how interest rate is on the rise, this net interest margin is expected to expand, which will directly benefit the bank's net interest income. Then the next question would be like, because right now the Fed is raising rates pretty aggressively, so there were a lot of comments about how this may lead to a recession if it goes a bit too fast. So I want to take this today, like take this opportunity to share a little bit insights from the management of the global banks in their first quarter earnings results. So what was interesting that they point out is that so far, there isn't any delinquencies that they are seeing across the consumer segment. So that's the first thing I want to share. So they're saying that consumer spending is still strong, and the consumer household balance sheet is still very, very healthy because of the insignificant stimulus checks that was given in COVID last year. So the consumers are now sitting on more than 4 trillion cash. So I think one of the banks also pointed out that they are not seeing any delinquencies yet in the consumers' assets, even in the low to moderate income segment. So another thing is that if you're afraid that the Fed will go a little bit too hard, too fast, there might be a recession, which will directly affect the banks because the banks are cyclical in nature. So another thing that almost all the banks have shared during the first quarter earnings result is that they are seeing upside to loan growth because of the increasing capex demand from corporates in almost across all sectors. So this is because over the last few years, I think many of them has pulled back on capex spending for certain reasons, and also they are now increasing capex because to meet consumer the rising consumer demand. So all these are actually pretty good news for the banks because of you have loan growth, you have upside to loan growth, and you also have like a expanding net interest margins will also support the bank's income. So I think one sector that we are particularly fond of for at least this year and the next 1 year is really the financials. And this is not shared during today's entire event. So of course, the product that we usually recommend for financials is actually the iShares Global Financials ETF listed in the US with a ticker code IXG. So this is something that y'all can expect from us in the next few weeks. We'll be sharing a bit more about this sector.
I think just to add on also, I think if you look at the performance of our regional markets this year, the ones that have really been doing well are those that are your traditionally value-oriented markets, like for example ASEAN. Singapore is definitely one of the best performing markets this year. You've also got Malaysia, Thailand, Indonesia. These are all very resilient markets amidst volatility in global equity markets. And the reason for that is because of their exposure to the value sectors, including what Ferlin has just mentioned, financials. So all these markets, they have been very resilient. And if you expect interest rates to continue going up in the future, then I think ASEAN, that's also something to consider. And also, given our reopening wave in the ASEAN region, China, you've got obviously a lot of downward pressures on the economy, but ASEAN so far, it has been very resilient and holding up very, very resiliently this year amidst all the volatility.
Right. Thank you, Viren. So, and rising interest rates, right? Still remaining on this topic, I think it also impacts commodities and energy prices. So maybe the next question, we can touch on the outlook for energy prices. Is there still room for growth?
I think energy prices are probably going to remain higher for much longer. So the obvious driver for energy prices right now is your Russia-Ukraine war. So that's the obvious driver. But beyond that, we see structural factors pushing up oil prices in the long run. So in the past, when demand was robust, when oil prices were high, you see oil companies pumping more oil. You see a lot of them investing heavily in production capacity. But this time around, you don't see that happening. And the reason for that is because of ESG considerations. You've got investor activism. You've got investors forcing all these oil and gas companies to invest in clean energy. And it is now a crime to even talk about oil and gas because of climate change and things like that. And that has resulted in underinvestment in your energy infrastructure over the years. So over the next few years, supply is going to be very tight, because even if companies right now, even if they ramp up on production, these new production, it will probably take a few years before they can actually come on stream to contribute to the global supply of oil and gas. So it will take some time for supply to pick up, even if they do decide to invest. And then you have also factors like energy security. Russia, after what Russia has done, I don't think Europe is going to go back to Russia for their energy supply. And this also means that European economies, either they invest in their own energy infrastructure or they go to alternative suppliers. They go to the US, they go to other countries for their energy needs. And this is going to chase the existing limited supplies of energy that we have in the world and further pushing up prices. And I think the future is definitely clean energy. That's definitely the future. But at this point, we are still very reliant on fossil fuels. That's a reality. And it will take a very long time before we can get enough investments in clean energy to achieve our net zero targets. So as of now, we're still very dependent on fossil fuels. And on the demand side of things, I think that is going to still remain high, at least in the foreseeable future. So we do expect some upside in terms of oil prices, even if right now we have, let's say, a peace treaty or a ceasefire between Russia and Ukraine right now because of all these structural factors.
Right, thank you, Wiren. So maybe we take a break from interest rates because like 3 straight questions on interest rates. Maybe we can talk about China for a while, because I think a lot of investors are also concerned about China and its ability to achieve its GDP growth target. I believe it's right 5.5%. And if so, by when? So, Wiren, maybe you want to carry on?
I think the consensus right now is that China is probably not able to achieve its 5.5% GDP growth target because of all the downward pressures that are putting downward pressure on its economy right now. You've got COVID zero, and you've got uncertainty on the regulatory front. So I think that's the consensus right now. But for us as a house, we are still confident that China is still able to achieve its GDP growth target for a couple of reasons. So the first reason is it's political. This year is a politically sensitive year for President Xi Jinping because he's going to seek a third term as the president of China. And he wants to show the world that China's economy has been under good stewardship and that China's economy has grown significantly under his leadership. And that is what he wants to show. So I don't think he wants to go into his third term with China's economy in tatters and with the Chinese economy not performing well because of all that downward pressures that it is experiencing right now. So first reason is political, and second reason is also because we think that a lot of support measures is on its way. So China is an economy of priorities. So a couple of years back when it was tackling excessive leverage in the economy, so deleveraging was the top of its economic priorities. And then last year you have got your the crackdowns on tech sector, the real estate sector, and the objective of this is to reduce the systemic risk posed by all these different sectors. Recently, that objective, that priority has changed because the government has come out to say many times that its priority right now is to stabilize the Chinese economy. So this is top priority right now. And you notice also the Chinese government, they talked about common prosperity for a very long time last year. But when was the last time you actually heard about Xi Jinping talking about common prosperity? You don't hear him talking about that right now because that has clearly taken a back seat. His priority right now is stabilizing the economy and economic growth. So in order for China to be able to hit its 5.5% GDP growth target, they have to do more. They have to introduce more stimulus measures, and they also have some funds left over from last year to spend. So at this point, if they don't do anything more, I think it's difficult for them to achieve that 5.5% GDP growth target. So we think that more stimulus support is on the way, and we think that China is still on track. They are still able to achieve that 5.5% GDP growth target.
Just to add on a few points to Wei Ren's second point about policy support, I think China and also the rest of the world, for instance, like the US, they are in very different stages of the economic policy. So China is currently on its way to, it's currently going for a more accommodative monetary policy, while the US, on the other hand, it is tightening. But inflation rates in the US, they are at near a 40-year high. However, inflation rates in China, they are rising. It's about 1 plus 2%. It's still manageable. So it gives the government more room to actually enact all these accommodative monetary policy measures also. And also recently, President Xi Jinping, he also called for an all-out push for infrastructure spending. Things like traditional infrastructure, railroads, your ports, and also for advanced infrastructure like artificial intelligence and cloud computing to stimulate the economy. Yeah.
All right. So thank you, Wei Ren and Dejin. So so Dejin was talking about a comparison between China and the US. Of course, the two of the biggest economies in the world, and rightly so. If we talk about China, we cannot leave out US as well. So maybe Dejin, like back to you. You can give us your outlook about the US market.
Sure. So right now, I think the outlook for the US market, it is definitely not going to be as great as 2021. So 2021 was actually a fantastic year for US equities. But going into 2022, there are a number of headwinds. So the biggest challenge facing the US economy, US stock market right now is rising interest rates. And with the Fed aggressively raising interest rates because they have realized that inflation is not transitory, and because they're too slow to act, they're already behind the curve. They have actually upgraded their forecast for interest rates. So just to give you guys some perspective, before the March meeting, the March Federal Reserve meeting, they were only guiding about 3 to 4 rate hikes this year. And assuming each rate hike is for 25 basis points, that will bring the Fed funds rate to about 1% by the end of 2022. However, after the May meeting, they actually raised rates by 50 basis points. And the last time they did that was actually back in 2000s. And I think it goes to show that they are kind of worried about inflation already. And they are going to, and more importantly, they are also projecting more rate hikes ahead. And rates could potentially reach 2% by this year end. So I think the greatest challenge right now is the greatest risk is actually a policy misstep where the Fed tightens rates too much that it slows economic growth and sends the US economy into a recession. So this is something that the Fed will have to do delicately. It has to strike a balance between raising interest rates to lower inflation while ensuring that economic growth doesn't stall. Yeah. And on top of that, I think the outlook is also clouded by other issues such as the Russia-Ukraine crisis and also the lockdowns in China. And some of these things, they are really out of control of the US. They can't really do anything to change the outcomes of these events, not materially at least. And I think overall, US equities, even though they have fallen since the start of the year, I think in terms of valuations, they still seem rather expensive. And that's because you have to consider the valuation multiple PE earnings. Earnings have been revised down a little bit and could be revised down even more. And that's why valuations, even though prices have fallen quite a bit since the start of the year, valuations for US equities, they don't look extremely cheap right now.
I think there is also some good news on the earnings front, especially if you look at our first quarter earnings season. We've got a couple of high-profile earnings misses, especially from the mega tech companies like your Netflix. I think Amazon also didn't do well in terms of its latest earnings results. But other than these couple of high-profile misses, I think the majority of the S&P 500 companies, they have actually managed to beat earnings expectations. So on the earnings front, there is still some good news. Household balance sheets, I think that's also another silver lining in the US economy right now. Consumers are sitting on lots of cash because of the very generous stimulus measures by the US government. And this is also something that is highlighted. I think Feline just now mentioned a lot of the bank management. They have also said that consumer finances are in pretty good shape right now. So there is this cash cushion that consumers have to absorb any negative impact arising from higher interest rates as well as higher inflation. So yes, I think there is a lot of uncertainties with regards to the economic outlook for the US right now, but there are at the same time also silver linings that are mitigating factors for some of these downside risks that we are seeing in the market right now.
All right, thank you, Weiren and Tajin once again. So I think I'll just wrap up with with the last question, which is, do you guys think the era of low interest rate or cheap money, as many people call it, is over? Maybe Weiren, you want to start first?
Definitely. I think the question right now is how high interest rates are going to go, but we are definitely not going back to the era of a low interest rate environment anymore. So I think, so my answer to that is yes, I think it's over, and I think we all should be positioning for a period of high inflation as well as higher interest rates.
Anyone want to add on?
Yeah, basically what Weiren said, I actually agree with him. I think credit conditions in the US especially, it is rapidly tightening with interest rates rising, and the Fed is also going to trim its balance sheet. I think sooner or later, these will start to affect companies' margins and perhaps their bottom line earnings, and that could negatively affect their net income in general. So, and of course, interest rates, they also depend on inflation. So that's one thing that the Fed looks at. So assuming that inflation is going to stay elevated, it doesn't come down, then I think it's logical to assume that the era of low interest rates will probably be over. And what we should expect going into the next couple of years would be a high interest rate environment.
Right. Okay, so thank you, Weiren, Tajin, and Feline for your time today. If you have any questions which we didn't have time to answer today, feel free to reach out to us via email or by our live chat on the FSM1 website. So email will be advisory@fundsupermart.com. If you have any questions, just feel free to email to us. We are always monitoring that mailbox, so we'll get back to you as soon as we can.